how are you? I hope you'll be fine. So today our topic is how do wealth manager invest during the market crashes. So let's start our video. First of all, like my video and subscribe my channel for more informative videos. So investing in the mutual funds can be a great way to become wealthy. But what do you do when the market crashes? So market crashes are invariable, and the way you approach them can determine whether you are successful in a long run. And you can see it's very easy. If you are an inexperienced investor or concerned about your mutual funds holding during the recession, the guide we will guide the confidently walk you through the downturns. So, learning market crashes and the market corrections, stay calm and avoid panic selling. Investment horizon matters. So, here's a learning market crashes and the market corrections is a market crash. Refers to the rapid and sharp declines in decline in the stock prices, which is frequently brought on by economic or the on the geopolitical factor. Not all decline and through are the crashes. Other time the market experience a market correction, which is a more orderly decline of 10% or more to the correct overvalued stock. So for example, consider the stock market like a shopping mall. When the stores becomes too crowded with experienced good, less are purchased. The shop owner that cuts the prices so that buyers returns against their price reductions is like a market corrections. It makes investments more appealing for future expansion. Stay calm and avoid panic selling. So when market go down, everyone gets scared and most investors start panic selling. So panic selling due to fear locks in your loss and keeps you from profiting when the market bounce back. Instead, remain calm and have faith in your investments time frame. So investments horizon matters. Your investments horizon, the amount of time you have until you need to money plays a big part of managing market volatility. So if you have a long-term perspective, 5 or 10 years or more, short-term decline should not concern your history. Market always come back stronger. So diversify across the asset class for the portfolio productions. So diversifying is the process of the spreading your investments across various asset classes such as stocks, bonds, and real estate. And the goal of the diversified mutual funds protection can minimize risk during the economic slumps. And your examples, compare your investments to a cricket team. You would not depend on the batter alone. You do, and you have to have borrowers and all-rounders to win the match. Likewise, your portfolio need the various asset classes to keep the balance during the up and downs of the market. So think about the defensive stocks and liquid funds. So at time of the uncertainty, defense stocks are more stable than any other sector. They are from industries like healthcare, consumer goods and utilities, which deals in the products and the services that are essentials to people and continue to be used by them regardless of economic conditions. So for instance, irrespective of how poorly the market condition becomes, there is always a need for the medical simple household necessities and electrically. This steady demands keeps this introduced industry strong even amidst economic recession. Investments in the defense stocks among your mutual funds holding can be a buffer, minimize overall risk when market gets the extremely volatile. And if you can see market volatility approaching, and another astute moves is to keep a portion of your funds in your in liquid mutual funds, and these funds invest in short term. How low risk instruments can treasury bills, your commercial papers that provides the ready access to the cash flow all in time. So in contrast, the equity investments that need for the market to pick up the liquid mutual funds enable you to withdraw funds at a short notice and without incurring long-term sources. So take a look, but panic over your portfolio. So it's always a good idea to check your investments from time to time, but getting derailed by daily waivers can cause the undue stress. And rather than making hasty decision, be patient and check your investments to see if they remain in with your goals. So when you think about an exit strategy, so an exit strategy is important, but living at the wrong moment can cost you. Only sell investments if so your target has shifted. A specific fund is the persistently lagging behind its comparison index. You need the quick sketch of the reasons, and otherwise hold on the weight out of the stump. So market crashes are opportunities, and it's in the discussions, and smart investors can cashes are times of the purchase, and your time is work, and normally rupees 100 comes with the sale for the 700. So the key takeaway is be patient and don't panic, and the market correction happens while think about your investment horizon, and short-term losses as not important in the long-term. Diversifying between asset classes and this lower the overall risk. Invest in the different stock and the liquid instruments. They offer the stability and the liquidity. Make use to market crashes as an opportunity to buy. If you invest in sensibility, you can profit from the recovery of the market. So we can explain the conclusion and the liver comments. So everything we can explain that you need to know about it, and your patience and your panic work. So diversify between asset classes. This lower is the overall risk. So invest the defense stock and liquid instruments. They offer the stability and liquidity. And next you can see market crashes are opportunities in this disguise. When to think about an exit strategy, take a look, but don't panic over your portfolio. Think about different stock and the liquid funds. Diversify across the assets classes for portfolio protection, investment horizon markets. Stay calm and avoid panic selling, and do many more that you need to. So I hope you understand. Thanks for watching this video. Like my video and subscribe my channel for more informative videos. Goodbye.